and welcome to today's packed video, which is called S&P 500 lows are being retested, but where are stocks headed next? I will dive into US dollar, bonds, and several advanced concepts made simple with charts and data, so stay tuned till the end of the presentation to see what's really going on. I had been clear both at the beginning of the week and on Saturday's video that US dollar is the key determinant, the key factor that is going to keep US stocks uplifted, well supported, cushioned, however you call it, and thus far I do not see signs of US dollar breaking to the downside. So, one piece of the puzzle. Usually, when stocks go down, yields do not do such wild moves. So, whoever wanted to make the point that US treasuries are not exactly a risk-free asset had made it. There are reasons for that, and I will be diving into them within the latter part of this video, where I will be explaining in layman terms the basis rate and what it means, the current idea of basis rate being unwound. On Saturday I had featured the 10 to 2 year spread steepening, and you see the hockey stick, truly hockey stick, and this one is real, about the pressures being manifest inside the financial system. This is an oddity. Just as prior Friday I had been pointing to corporate financing oddity that had sent a certain message for equities, and that sign had been repeated midweek prior week, and that had coincided with the 2-day flush we had seen Thursday and Friday. And this is another part of the important puzzle, steepening of the yield curve. You can hear at many places being thrown around that this is the yen carried rate unwind and that Bank of Japan would be the one, the trigger. I am not subscribing to this opinion exactly because we had seen as well a retreat in Japanese government bonds. Sure, the 30 or 40 year Japanese government bond yield is higher and had different characteristics than this 10-year one. However, you see that the risk is not emanating from yields. This is a tariff, high stakes poker game, and currently it is about how US and China basically divided up the pie, what would be the terms, whether there would be more of a tariff war continuation, or whether what I had identified yesterday as very subtle signs of China wanting to actually floating the trial balloon of a negotiated settlement, whether these behind the scenes that neither of us can be in the picture about, whether these efforts would lead to a resolution. So, with 104% US tariffs against China and comparatively lower Chinese tariffs against US, I guess we had seen what could have gone wrong and what could have been, how could those screws be tightened. We had seen pretty much already the worst case scenario. And no, I'm not looking for Europe to go the confrontational route. You know pretty well that similar attempt by Macron towards the French business community was basically nipped in the bud, and it had not been serving to great reputational boost. So common sense is prevailing, and China knows that it is in a less advantageous position than the United States, because access to 35% of the world consumer market is a price not to be ignored. And just as whether we want to hear it or not, that is the truth. Neither US nor China can do without each other. They have to come to a solution. They have to come to a negotiated solution. And it's a question of time and how much pain before that we are going to go through. But you hear quite clearly what I'm saying as regards the headline risk, whether it is going to be towards relief or towards more crash, bullishness, doom, endless doom, and so on. So don't subscribe to all the fear porn drivers, because this is not the time to be panicking every single day. There are actually seeds of a solution and of a resolution. This is just the drama tightening screws part, and let's see where it goes from there. 1 to 3 year treasuries aggregate, so very short term one. We can see as well in here the ascent in yields, which quite agrees with the 10-year or longer duration perspectives, and this is precisely not what Besant would want to see on either end of the treasury market. So keep in eye that this is increasing uncertainty, and this tariff war is also through the bond market catching up with the United States. It's not just China yuan being pressed down towards the devaluation, and Chinese bonds being bid up. It's not just about that. One more look at the Japanese yen. It is not wildly appreciating, so this is basically not a leading role in this situation that we are seeing unfolding. This is not about Japan, so I don't entertain further thoughts based on the currency exchange and based on the Japanese government bond view that you had already seen. Euro is rising, and whoever wants to see stabilization in the US equity prices would like to see the dollar strengthening from here versus the euro, and that's of course as well versus the safe haven currencies such as Swiss franc. So this is still pointing to as much an elevated temperature in the financial system as the volatility picture, whether you look at VIX or VIX to short-term VIX or short-term VIX itself. So this is still pointing to a high stakes game being still played out. The daily chart, we are seeing not exactly a spike in volume. So sellers look a bit extended to the downside, and note that the various periods, percentages of stocks trading above various periods of moving averages got even more extreme. So the situation which was quite unsustainable and record when you look back at prior crisis flashpoints got even more so. So I would be really holding one's horses when it comes to calling for more downside. The case, as I say, now favors an upside headline risk precisely because of the negative, fearful sentiment and all the theories being floated from I will skip this part. There is no shortage of fearful drumming of what had been on the fringes a few years ago by quite mainstream financial following accounts. So I'm not subscribing to that point of view at the moment, and conversely I think that there is going to be some kind of an intermezzo returning us back towards at least the upper border of yesterday's daily candle. This is the 4-hour perspective, and you see the purely technical improvement on the MACD histogram, and that this could be provided that the bottom holds, important qualifier. This is a bullish divergence into making, and as well this picture quite clearly the volume comparison points to exhaustion of the sellers. So that's how I see the balance of stock price moves, macro factors, high stakes poker game, tariffs and international trade. And right now let's dive into what is behind the mystery of stocks suffering a setback and bond yields rising. Is the basis trade, and concretely it's unwinding. So let's examine first what is the basis. That's how the price between the price of a US Treasury security and its corresponding futures contract is different, and hedge funds and institutions with reasonably high leverage seek to profit from the futures contract nearing its expiry at a price closer to the actual underlying security itself. However, and this is the important part, whenever there is an increased supply of US Treasuries, which yet not been built up into the market expectations for the duration of the futures contract, when it is being actively traded as the current contract, then the basis trade gets disrupted, and it's an endogenous risk within the financial system that these over-leveraged market players would have to unwind this basis trade, which is treated as a similar no-brainer trade as the yen carry trade is during, say, more usual, typical, not extraordinary times. So there are several reasons that can bring about or result in increased US Treasury supply. There is floated an idea that China is in retaliation dumping its tremendous US Treasury stockpile. The same rumor is being said about Japan, which is another very significant foreign holder of US Treasuries, for the reason of internal stress within the Japanese system as such. Yeah, it's beyond Norin Chunkin. It's beyond that. Because the Bank of Japan is defending, of course defending, just as US Fed is, the Japanese government bonds. US Fed is defending US Treasuries. Treasury is defending US Treasuries. And this is at the expense of the currency, be it Japanese yen or be it US dollar value. So that's what we are seeing with the Bank of Japan defending Japanese government bonds at the expense of yen itself. Therefore, yen is not as much appreciating against the US dollar. Another reason leading to more supply of US treasuries would be if those hedge funds and institutions doing this basis trade would be badly squeezed and had to liquidate no matter the current cost or recovery prospects, which is what I would point to as the reason of yesterday's and what I had cautioned you already within yesterday's video, the day before, spike in US Treasury yields on the 10-year and longer durations. Similarly, if the Fed is doing quantitative tightening, that is another factor leading to this effect. But the Fed had not capitulated and is continuing. So it's basically, I would point to foremost number 3 and foremost number 3. The rest would be pure speculation of who is the one dumping US treasuries more to the market, whether it is China or Japan, and I don't think it is the Fed. So within this, remember as well that Japan is going the negotiation path, so they would not be messing with the US on the other end via treasury dumping. So, but I would look rather to Wall Street than to China when it comes to dumping of US treasuries. So that is explanation of how I see the reasons and prospects for the basis trade going forward, and it is having that same element of forced selling as what I had cautioned you about in Saturday's video, where I talked the suspicious selling, straight selling towards the close across S&P 500 sectors. That was the video where I talked rising credit spreads, yield curve steepening, and rising credit default swaps. So just make sure to review that video once again. My join page will help you select what's right for you best of what and how you trade. You must be familiar with that site, and everything else you must know already.